Today we're going to talk about interest rates and really what pushes rates up and down. I'm going to try to simplify it. I'm going to search for words probably because this is kind of off the cuff a little bit, but this is the third take. So let's see if we can get it to go, a good go. So my name is Mike Florin. I'm the owner of Low Cost Mortgage. It's your weekly update for the last week of September 2023. Now, rates are on an uptrend. We all know it, right? You can see it. My 10-year treasury is on your right side, my left shoulder. And on my right shoulder is the MBS chart. We're using the 6.5. This one's not flipped because it's on a screen and I actually have to manually flip it for everybody. Now, to overly simplify, and again, we're going to overly simplify so everybody kind of understands something. Rates are not directly influenced by any one thing. They're really not. What they are is there's pressure on the rates themselves, or the MBS rates. So for example, overall core rates, if the economy is doing really well, rates actually have an upward pressure to them. The rates tend to go up a little bit. If the economy overall is doing bad, rates tend to have a downward pressure to it. The 10-year treasury, if the 10-year treasury goes up, rates go up. If the 10-year treasury comes down, rates go down. That's typically a good correlation, or I want to say an indicator. So you'll see a lot of us in the industry, we're going to look at the 10-year treasury and say, okay, what is the 10-year treasury showing? And that's a good indicator of what rates are going to do, right? But now let's talk about pressure. And I'm going to use the word pressure a lot, okay? Unemployment. In times like this where we're trying to keep inflation down, high unemployment is good, downward pressure. Low unemployment is bad, upward pressure on rates. The 10-year treasury auction goes up, upward pressure. 10-year treasury is weaker and downward pressure on rates. If we have what we have right now, which is Congress cannot pass a budget, there's a lot of financial instability attached to that. You've got furloughed employees and you've got other things happening. So if they can't pass a budget, instability is upward pressure on rates. And that's one of the big catalysts over the last 2 weeks, especially this week. If they can't pass a budget, rates go up. Well, guess what? If we go into next week and government shutdown, no budget passed, rates will probably go up again next week. Now, there is some silver lining to this, and that is you really need to find a lender or an outlet that focuses on offering lower rates, right? So our conventional, I just ran it. You can too. It's on my screen over here on my right, your left. Conventional is low sevens. Not much of a movement from a few weeks ago, but it is a bit higher. Not a lot higher, but a bit higher. And Govy was mid sixes. Again, it's not low sixes, but it's mid sixes. You're looking at the cost to the borrower on a monthly basis for the same home, average thing, you know, in Washington, Colorado, North Carolina, Texas. Average sales price, we're just going to say 400 or so. You're looking at a payment difference of about $100 a month or so based on rate changes from a few weeks ago to now. So is it a deal breaker on a $2,800 a month mortgage to go to $2,900? Probably not. But at the same time, yeah, it kind of sucks having a higher rate, right? Having a higher payment. But the big thing is rates right now are temporary. Every loan that's being generated right now, and it's not a punchline or anything else, this is basically a statement of fact. I can't say it's 100% true, but it's 99.999% true. Every loan that's going to be generated now, there's an extremely high probability it will be refinanced as soon as there is some stability in the markets and rates come back down. Now, before the pandemic, rates were government, low fours roughly, right? And conventional was high fours, and some owner-occ or non-owner-occ investment property was low fives. We were doing loans like that about a year before the pandemic hit. Now, is that a rough indicator of where rates could be? Kind of, yeah. If everything stabilizes out, rates could go back there. When? I don't know. This next election cycle is going to be a big dictator as to what happens there, but we just have to sit back and watch, because all of us watching this YouTube video right now, none of us can affect change. We are not in those positions to do so. Of course, I have my opinions, everybody else has theirs, but at the same time, there's nothing we can really do about it. I wish there is, but there's not. Except offer really low rates and try to get customers in the system that work really good. Like, for example, for us, we have really good deals, but your buyer has to have a laptop. They really have to have a laptop. They have to understand technology, and they have to have a pretty clean income file. Not really pretty clean income file, but they need to take care of their credit. They need to take care of business. If they've got that, they're going to find a good deal with us, or there's a few others that are offering pretty good deals too. But if they're not, they're probably not in the market right now. So my advice, remember I was a realtor too for quite a while, about 20 years ago. My advice to you realtors out there that are looking for buyers is start to focus on not really the higher net worth people, because their files can be a little bit messy, but the good credit, they save some money, they do those kinds of things, they're very responsible with how they live their life. Those people are buying, and we're doing a lot of loans for those kinds of people right now. VA and conventional, right? You take care of yourself, you take care of business, and you buy. And you can still buy in this market, and we're doing a lot of closings. So anyways, Mike Florin, Low Cost Mortgage. I'll talk to you later. I'm done rambling. Have a great day.